Good afternoon, friends. It's indeed a great pleasure for me to be doing this session on valuation of a land and building, and that is, we will take a five-star hotel based on the discounted cash flow method. Based on the discounted cash flow method. We have about an hour to cover this session, and it is going to be my endeavor to present this case study in a manner that you are able to comprehend it very easily. My endeavor is going to be to present the discounted cash flow method in a manner so that you are able to comprehend it and comprehend it forever. Now, before I start this session, I would request all of you to please post all your doubts, questions, and queries about the discounted cash flow method. I'm aware that most of you, who about 200 of you, are specializing in valuation of land and building and plant and machinery. The discounted cash flow method is relevant for the land and building also and plant and machinery also. So I would request all of you to please post all your doubts, all your queries, all your questions relating to discounted cash flow method in the chat box. And I'm going to give you time of 2.5 minutes for doing so. I'm sure during the process of this session, I would have covered all the doubts and the questions and the queries that you would have raised. In case something still remains, before we close this session, I will take all your doubts, I will answer all your doubts, all your questions, and all your queries towards the end of this session. So I'm just giving you a time of 2.5 minutes. Please write down, post all your doubts, questions, and queries in the chat box. And it's not that you have to write your doubts and questions only now. As a matter of fact, you can keep on doing so. So as we go on discussing the discounted cash flow method, how to use discounted cash flow method for the evaluation of building a real estate property primarily, you can of course keep on writing those doubts and questions even while we are conducting this session, and therefore I will now start the session. So let's begin. Let's start from the start. What is value? What is valuation? Why valuation? What we find through valuation? How to do valuation? What is premise of valuation? And how to use discounted cash flow method for valuation? Very quickly, just to be on the same page, just to ensure that all of us are on the same page, what is value? The simplest definition that I can give of value is nothing but utility of an asset. Value is nothing but utility of an asset. An asset that does not have any value, an asset that does not have any utility, that asset has got no value. And an asset which has got some utility, whatever it may be, it has got some value depending on what is the utility of that asset. What is valuation? Again, in the simplest words, the valuation is nothing but quantifying utility of an asset in terms of money. That is what is valuation. Quantifying the utility of an asset in terms of money, that is what is valuation. Why do we do valuation? And we do valuation because we have to take a decision. We have to take a decision. So we will do valuation only when we have to take a decision. If we do not have to do, if we do not have to take a decision about any asset, obviously we will never do valuation of that asset. So why valuation? Because we have to take a decision. What we find through the valuation is again very simple. It is the fair value. And why do we find the fair value? We find the fair value because there is a buyer and there is a seller. Both of them have to take a decision, and both of them will take a decision of buying or selling only when both of them feel that the price that has been arrived or the valuation that has been arrived of that particular asset is fair. And that is what we try and find out, the fair value. So why do we find the fair value as the valuation professional, whether for land or building or the plant and machinery or for the financial assets? Why do we try and find the fair value? We try and find the fair value so that the process of decision making is facilitated by at the end of the buyer as well as at the end of the seller. How to do valuation? Of course, we all are aware as to how to do the evaluation, but quickly I will just again, to be on the same page, we'll spend about a minute and a half in understanding as to how do we do valuation. What is premise of valuation? We all are aware. It is either valuation is the premise is the liquidation, where the company is going to close, or it is going to be the premise can be going concern. That means it is a running business which is to be valued. And depending on the premise of the valuation, the method and the approach also would change. And how to use the discounted cash flow method for the purpose of valuation, that is what we are going to discuss with the help of a hypothetical case study. We have a limited time of only about 1 hour, and therefore I just thought it would be simplest for me to explain to all of you the discounted cash flow method by taking a hypothetical case study. So how to do valuation? There are approaches. So there's an approach which is income approach, market approach, and the asset and the cost approach. All of us are very much familiar with all these terms, and therefore I do not wish to spend any time in discussing them. Under the income approach, we have the income capitalization method, or we have a discounted cash flow method, and the discounted cash flow method is the focus of our discussion today. Under the market approach, generally in case if the asset that you're trying to value is listed on any exchange, then you will prefer, or you will take the quoted price as the value of that asset. If the asset is not listed on a stock exchange, in that case you will use two methods, that is comparable company method or the comparable transaction method, depending on as to what you are trying to value. Are you trying to value a company? Then you will use a comparable company method. Or you are trying to do the valuation of a transaction, in that case you will be using comparable transaction method. Under the asset or the cost approach, there are four methods primarily. Number one is book value method. Very simple. Book value method would mean pick up the balance sheet of the company, and whatever are the values shown in that balance sheet of different assets and the liabilities, take those values. So from the figure of the assets, divide the figure of liabilities other than the equity, of course, and what you get is the book value. Then you gotta have a adjusted book value method, which means what? Which means you don't pick up the numbers as given in the balance sheet. You will adjust them, or rather you will pick up the adjusted number. Now what would it mean? It means if you have a land that was bought 30 years back at a price of 1 crore, and today that land is, the market value of that land is 50 crore. So you will not take, for the purpose of finding out the adjusted book value, you will not take 1 crore as the value of this asset or this land. Rather, you will take the value which is 50 crore, and that is why it is called as adjusted book value method. And then of course you got a replacement method. Replacement meaning replacement in the situation in which it is today, and that is what is your replacement method. And liquidation value method would mean if all the assets of this company are sold, how much money would you realize minus how much expenses you will incur in realization of the money. The net value becomes the liquidation value method. Now typically this is the quoted price is referred as label 1. So just for the benefit of everyone, there is an accounting standard which is India's 113, which is on fair value measurement. Now, this accounting standards, fair value measurement, India's 113, talks in terms of three different level input. So what does it say? It says that when you have a quoted price available or with regard to an asset, you pick up that quoted price and take that as the price or the value of that asset, and that is referred as level 1. And then it talks about level 2 input. Now, what is level 2 input? In case if the asset is not listed on exchange, in that case, how do you find out the value of that asset? So you will find out the value by using the market information. So market information, and that market information is known as the level 2 input, right? So comparable company or comparable transaction, that is level 2 input. Now, the India's 113 also talks in terms of level 3 input. Now, what is level 3 input? The level 3 input is there is a company. This company is not listed, and this company does not have a comparable company, yet you want to do the evaluation of this company. So how do you do the evaluation? So the India's 113, which is on fair value measurement, it talks in terms of level 3 input. And what is level 3 input? Level 3 input is the discounted cash flow method. So what the level 3 input says, it says that in case if the company is not listed, there is no other company which is comparable, and you have to do the evaluation. In that case, what you do, you create your own information for the purpose of doing the evaluation of this company. And now, what is the meaning of creating of your own information for the purpose of valuation of this asset or this company? And that is using the discounted cash flow method. So which means what? Which means try and find out as to what kind of cash flow this company is going to generate over its life, and present value of that cash flow is referred as the value of that company, is the valuation of that company. And why it is referred as discounted cash flow method? It is referred as discounted cash flow method because what we do in case of a discounted cash flow method, we find out the projected cash flow accruing or resulting from that asset or from that company. And then what we do, since the cash flow that we are getting is accruing or is arising or is happening over in future. So, and we understand by experience and otherwise that the time value of money changes with the passage of time. So 100 rupee in my hand today and 100 rupee in my hand 1 year from hence are not same. Invariably and generally speaking, the 100 rupees that I have in my hand 1 year from hence has got lesser value than the 100 rupees that I have in my hand today. So what we need to do, because I cannot compare 200 rupees, 100 rupees in my hand today and 100 rupees in my hand 1 year from hence. They are not same in the value, but I have to take a decision. So how do I take a decision? I take a decision by converting the future cash flows in terms of present value. And how do we convert the future cash flows in terms of present value? By discounting the future cash flows. So when we discount the future cash flows, we are able to convert those future cash flows in terms of present value, and that is how they become the comparable cash flows, and that is how it is also referred as discounted cash flow method. Now, I am sure with the experience of all of us, we would agree with me that income approach is the most fundamental, dependable, and reliable method of valuation. So any company, any asset which is capable of generating its own free cash flow, then the only method that should be used for the purpose of valuation of that asset is the discounted cash flow. So the discounted cash flow method, it by default, it would also mean that the discounted cash flow method can be used for the purpose of valuation of an asset only when that asset has the capability of generating its own cash flow. So any asset which does not have the capability of generating its own cash flow, or any company which does not have the capability of generating its own cash flow, that company or that asset cannot be valued using the discounted cash flow method. In such case, the only option would be, because the asset or the company does not have the capability of generating its own cash flow. So the only option that would remain for the valuation of this company or this asset is either going to be under the market approach, or it is going to be under the asset approach. In case of a company where you are using the discounted cash flow method, you can use the market approach for the purpose of confirming your valuation that you have arrived using the discounted cash flow method. As regards the cost approach or the asset approach, it is good only in case of, number one, the assets which do not have the independent capability of generating the cash flow, and number two, the assets which are in the process of being liquidated. So this is how, friends, we do the valuation of different kinds of assets. Now let's come back to the case study. Now what this case study is, and as I said earlier, this is only a hypothetical case study, and I thought the best way to explain the discounted cash flow method is to use this hypothetical case, and I'm sure you will find it so. So as a valuation professional, you have been approached by an international hospitality group for valuation of the hotel Park Inn by Radisson in Nagpur using the discounted cash flow method under the income approach. So you have got this assignment from an international company, and they have asked you to do the valuation of a hotel because they are intending to acquire that hotel, and therefore they want you to help them in finding out the fair value of this hotel using the discounted cash flow method. So how do we use the discounted cash flow method for the purpose of valuation? Now valuation, remember, in this case can be in two ways. Number one, the valuation of a hotel can be done as a property, and number two, the valuation in this case can also be done of the company as such. So using the discounted cash flow, you can do the valuation of the hotel as a property, and you can do the valuation of the hotel as a company as well. So how do we do that? So for the purpose of doing the valuation of the hotel as a property, what we will need to do is we will need to use 6 steps. So using these 6 steps, we would be able to find out the discounted cash flow value of this hotel. And after that, in case if we also wish to find out the value of the company, because all said and done, of course both things can happen. It is always possible that there is a company which is having 10 different hotels, and this company is wanting to divest one of the hotel, or is wanting to sell one of the hotels. So that can happen. In that case, only the hotel would need to be valued. And it is also possible that the entire company is also being taken over by someone. In that case, the entire company will need to be valued. So in that case, for the purpose of valuation of the hotel as a property, there are 6 steps. And for the purpose of doing the valuation of the company as such, there are 3 additional steps that will need to be performed. By the way, in case if any one of you have a question in between, you can unmute yourself and you can ask me that question. But remember, your question should relate to only what I am discussing. So if there is something that I have explained and it is not clear to you, you want to have clarification on what I am discussing with you, you can certainly unmute yourself and ask me this question. All the other questions pertaining to the discounted cash flow method, I'm going to take at the end of this session. So let us begin with the 6 steps to valuation of hotel as a property. So first we take the 6 steps relating to the valuation of the hotel as a property, and then of course we will come to the remaining 3 steps that we would need to carry out for the purpose of doing the valuation of the company as such. So the step number one that we need to perform for using the discounted cash flow, and that is we need to find out, number one, something which is known as explicit forecast period, EFP in short. And number two, we need to find out is the terminal period, and that is TP. Now, what is explicit forecast period or what is the terminal period? Let me explain this to you. Remember, in case of the discounted cash flow method, what we do, as I mentioned a little while ago, we find out the projected cash flow. And why do we find out the projected cash flow? And that is again very simple. As I said in the very beginning, what is value of what is value? Value is nothing but utility of an asset. And what is valuation? Converting utility of an asset in terms of money is valuation. So in case of discounted cash flow, what we are using the projected cash flow. So what is the utility of a business? And I'm sure all of you would agree with me. Utility of any business anywhere in the world is one and the same. And what that utility is, that utility is the ability of the business to generate the cash flow. Ability of the business to generate the cash flow. So if we have to find out value of a company or of an asset, what we need to find out first is the cash flow. Remember, there is a small challenge. So what is the challenge? The challenge is if we have to use the if we have to use the cash flow for the purpose of finding out the discounted cash flow value or the present value, we will need to find out the cash flow for all the years to come of this company. Now, is that possible? Answer is no. And why the answer is no? Because apparently any company and every company that is started anywhere has got an infinite life. That means we never know as to when this company is going to stop, right? So that means what? That means, really speaking, for using the discounted cash flow, what we should do, we should find out the cash flow of this company for infinity and then discount that cash flow. Now, is that possible? Answer, of course, is yes. It's not possible. So then what do? We break the cash flow of this company whose valuation we are trying to find out using this discounted cash flow. We break the life of this company into two parts. Now, what these two parts are? These two parts are, number one is explicit forecast period and number two is the terminal period. Now, what is the explicit forecast period? Explicit forecast period is also known as super growth period or high growth period or extraordinary growth period. And what is the terminal period? Terminal period begins from where the explicit forecast period ends. So let's say, for example, the hotel that we are discussing, the case that we are discussing. Now this hotel has to be valued. So if this hotel has to be valued, the present value of the cash flow of this hotel will need to be found out. So what we will need to do? We will need to break the life of this hotel into two components: explicit forecast period and the terminal period, as I have just mentioned. So how do we find out the explicit forecast period? So for finding out the explicit forecast period, we will have to do some homework. We will have to do some market survey. We will have to do some research. We will have to do some consultation with the people who understand the hotel industry or people who belong to the hotel industry. So what we will try and find out, so we will talk to people who are from the hotel industry in Nagpur and check with them as to how do you see that for how many years this hotel is going to have extraordinary cash flow or extraordinary growth. So let's say we talk to the people who are from the hotel industry and who are expert about the topography and geography of Nagpur, and they tell us that any new hotel which is set up in Nagpur, for first 5 years, that hotel will have a super growth, extraordinary growth. So that hotel will grow, let's say, at 15%. And after the period of 5 years, the growth will normalize, and the normal growth is going to be 5%. So the explicit forecast period we have understood is 5 years in this case, and the growth rate during the explicit forecast period, as understood from the experts, is going to be 15%. And once the explicit forecast period is over, the growth will normalize and come to 5%. And as I said, this 5% is going to be the growth rate for the terminal period. Now, please remember, terminal period starts from the time when the explicit forecast period ends, but the terminal period has got infinity. So that means it goes for infinity. But this model, this is known as two-stage discounting model. This model helps us to find out the present value of any business in any case. So that is your first step to find out the explicit forecast period and the terminal period. By the way, terminal period is also known as continuing period. Both mean the same thing, and I'm sure you can understand as to how both mean the same thing. The second step, which is involved in using the discounted cash flow method for the purpose of valuation, is to estimate growth rate during the explicit forecast period and during the terminal period. And as I discussed a little while ago, how do we find out the explicit the growth rate during the explicit forecast period? By talking to the experts, and both the rates actually. And in this case that we are discussing, we have already understood as to the growth rate during the explicit forecast period is going to be 15%, and the growth rate during the terminal period is going to be 5%. And I'm sure, friends, you can very easily understand as to when the business is started. So it grows at a rate of a high rate because it is just starting the operation. So year after year, the operations are ramping up. Since the operations are ramping up, the growth is going to be higher and higher during the explicit forecast period. After a while, the growth stabilizes and then it becomes a normal growth. So that is your step number 2. Estimate growth rate in earnings during the explicit forecast period as well as during the terminal period or the continuing period. Then the third step, which is very critical and very crucial, and that is estimate projected free cash flow during the explicit forecast period and also during the terminal period or the continuing period. Now, friends, in using the discounted cash flow method, this stage is very critical. And why this stage is very critical? Because when you are projecting the cash flow, you have to take all necessary precautions. What precaution? Precaution number 1, that whatever income that you are assuming this hotel is going to generate over next 5 years and thereafter, you have to be as realistic as possible in estimating the revenue that this hotel will generate over its life, broken into explicit forecast period and the terminal period. Now, why that is important? And that is important because ultimately, what is value? Value is utility. In case of this hotel, what is the utility? In case of this hotel, utility is the cash that this hotel will generate over its lifetime. So if we make a mistake in projecting the cash flow, that means either we are over optimistic in our computation or we are extra pessimistic in our computation. In both the cases, the value that we will arrive is not going to be a fair value. And why it is not going to be fair value? Because we are over optimistic. That means what we are doing, we are taking revenues to be on the higher side and maybe we are taking expenses on the lower side. As a result of that, the value that one will arrive using the discounted cash flow method is going to be on the higher side. And if it is on the higher side, it is not a fair value. Likewise, in case if we are over pessimistic about the cash flow, projected cash flow, then what we are going to do is we will be underestimating the cash that the business will generate, and therefore the value that we will arrive is going to be on the lower side, and which is again not going to be a fair value. And therefore, whenever you are using the discounted cash flow method, remember, one has to be absolutely realistic in making the projections. As a matter of fact, as a valuation professional, that is our prime responsibility. So when the client comes and gives us the number, projected financial cash flows, gives us the number, it is our responsibility as a valuation professional to ensure that whatever numbers the client has taken are based on the realistic situation and not on the over optimistic situation or over pessimistic situation. And that is your step number 3, and that is estimating the projected cash flow. So remember, how do we find out the projected cash flow for the explicit forecast period? Of course, we will have to find out, and I'm going to show it to you as to what can be the sources of revenue in case of this hotel. So we will need to estimate as to what kind of revenues this hotel is going to generate year after year for next 5 years, and then the last year's projected cash flow. And in case of our hotel that we are trying to value, the 5th year's cash flow, the 5th year's cash flow into the normal growth rate, or the growth rate that will be applicable during the terminal period. Now that becomes the cash flow for the terminal period. That means the terminal period cash flow is going to be cash flow of the end of the explicit forecast period into the growth rate of the terminal period, and that becomes the cash flow for the terminal period. I'm sure you must be wondering as to how this one cash flow will help find out the cash flows of the remaining years. And I'll explain to you the formula that is there takes care of that requirement as well. Now, as far as the cash flows are concerned, remember, the cash flows can be understood in 2 ways. Number 1, free cash flow for the firm and free cash flow for the equity. Now, what does it mean? Remember again, what is the value of a business? Is utility. And what is the utility of a business or a hotel in this case? Is its ability to generate cash. So the cash that the business can generate can be of 2 types. So one is free cash flow for the firm and free cash flow for the equity. Now what does it mean? It simply means free cash flow for the firm. What does it mean? It means that the cash flow which the firm is generating, and it is available for the benefit of all the capital providers. So that means free cash flow for the firm will mean the cash flow which is available for the benefit of all the capital providers, the lenders, as well as the shareholders. And what is the meaning of free cash flow for equity? It would mean the free cash flow which is available only for the benefit of the equity shareholders only. And that is the difference between the FCFF and FCFE. So when we are trying to find out the valuation of this hotel, we will need to estimate the projected cash flow. So for the purpose of projected cash flow, what are the sources of revenue in case of this hotel? Number 1 is renting of the hotel rooms, food and beverage services. Then the broad category is of meetings and events. Under the meetings and events, there may be meetings happening in the hotel for which clients will be paying cash. Conferences will happen, weddings, social get-together, and the other functions that will take place. So these are some of the sources of cash or revenue for the hotel. Then you also have the restaurants and bar in the hotel. There are in-room dining, outside catering services. So some hotels also provide the outside catering, and then Some hotels also have the business center facility. So and then of course some hotels also have renting of offices and shops. So these are broadly the heads under which this hotel will be generating the cash. So this will need to be projected for first 5 years, and simultaneously what will also need to be projected are the expenses. So what are the expenses that the hotel is going to spend over next 5 years? So the expense on everything, on food and beverage, on the employees, on interest, on depreciation, on administration, like in case of any other company, same way you will also need to determine as to what are the expenses this hotel is going to incur for running its operations, and we will need to project those expenses also. And then of course, so we will have the revenue. From the revenue minus all the expenses, then we arrive at the figure of PBT. From the figure of PBT we deduct the taxes, and then we arrive at the figure of PAT. So PAT plus depreciation, amortization, put to, and then of course you will also need to make adjustment for increase in the assets or decrease in the assets, and likewise increase in the working capital or decrease in the working capital. So in case if there is an increase in the fixed assets, so increase in the fixed assets would mean cash outflow. Decrease in the fixed assets would mean cash inflow, and likewise increase in the working capital would mean cash outflow. Decrease in the working capital would mean increase in the cash inflow. So all these factors, and likewise in case if the business is taking a new loan, so if the new loan is being taken, the new loan will be added to the cash flow because so much of cash is coming inside the business. If any loans are being repaid, then repayment of the loan will be considered as outflow. So after making all these adjustments, you will arrive at the figure of your free cash flows. And now you come to the stage 4, and the stage 4 is determine the cost of capital. Determine the cost of capital. Now friends, remember this fourth stage is again equally critical. And why do we need this cost of capital? Why do we need this cost of capital? So first of all, let's understand what is the cost of capital. So cost of capital in simple words is this hotel has got started or has come into existence because somebody brought capital into it. So who brought capital into this hotel? Number one, the shareholders brought capital into this business, into this hotel, and the lenders also brought the capital into this business. So it is on the strength of the capital brought into this hotel by the lenders and the shareholders that this hotel has come into existence. So as we were discussing earlier, that under the discounted cash flow method, what do? We do the discounting of the future cash flows. So for discounting the future cash flows, we will need to take a rate. And what that rate is nothing but the cost of capital. That rate is nothing but the cost of capital. So if we are considering cash flow for the firm, then we will have to take into account the cost of weighted average cost of capital or cost of capital employed, in case if we are taking the cash flow for the firm. In case we are considering the cash flow for the equity, in that case we will only need to take into account is the cost of equity for the purpose of discounting. Now please remember as to why do we do discounting and why do we need to take only the figure of cost of capital. Can we take any figure for the purpose of discounting the future cash flows? Answer is no. And why do we do discounting? Are we trying to find out the purchasing power of the future cash flow by discounting? Answer again is no. Please remember, we do not do discounting because we want to find out the purchasing power of future cash flow this hotel is going to generate. We cannot take any rate that comes to our mind for the purpose of discounting the future cash flow. So we have to, number one, be very clear. We do the discounting because we want to make the apple to apple comparison possible. So the money which I am putting into the project today is going, the money which is going out is today. And the money that I am receiving from this hotel is going to be over the years. As we have understood in the beginning of our discussion, that the 100 rupee in my hand today is not same as 100 rupee in my hand 1 year from hence, 2 year from hence, or 3 year from hence. So what I will need to do, I will need to discount the future cash flows. And what I do, I use the cost of capital. Whose cost of capital? Whose cost of capital? Can there be a common cost of capital that can be used? Answer is no. The cost of capital that we have to use for the purpose of discounting of the cash flow has to be the cost of capital of the person on whose behalf you are doing the valuation. So remember, the buyer and the seller both will have a different cost of capital, and the person who is doing the valuation of buyer and the person who is doing the valuation for the seller are not same invariably. They are different. And because they will both need to take into account the cost of capital of the buyer and cost of capital of the seller. And why? Because you want to find out the value of that hotel from the perspective of the buyer, in case if you are doing it on behalf of the buyer, or you want to find out the value from the perspective of the seller, because you are doing the valuation on behalf of the seller. So what you will do, you will use the cost of capital only, not any random number. So this number, cost of capital, has to be calculated properly. So how do we calculate the cost of capital and the cost of equity? So number one is assuming that this hotel has been funded by mix of debt and equity. If this hotel has been funded by mix of debt and equity, so what we will need to do, we will need to calculate something which is known as WACC, that is weighted average cost of capital. So you call it weighted average cost of capital, or you call it simply cost of capital employed. Both mean the same thing. Now here what we do, we pick up all the sources of the fund from where the money has come into this business, and then we find out what is the cost of the respective sources. Now typically, of course, when you are doing the evaluation of in real time, then you will have to find out the cost of equity based on the capital asset pricing model. But in our case, we have taken the cost of equity as 15%, and the cost of reserves also we have taken as 15%. Now, why is that the cost of equity and the cost of capital are same? And that is because equity belongs to the shareholders, reserves also belong to the shareholders. Now, since both these sources of fund to the business belong to the shareholders, and therefore their cost of capital cannot be different, it has to be same. So we have, and invariably, friend, I've delivered these programs all over the world in more than 50 locations across the globe. I was working with a company called ArcelorMittal, which is world's largest steel and mining company. And in my role as head of learning for finance for the entire group, I traveled all over the globe and delivered these programs, and understood that globally 15% is considered to be a reference rate. If you do not have a specific rate available, then 15% is a reference rate used for the purpose of taking these decisions, the cost of equity or the cost of reserves. Now this hotel also has a preference share capital. So in case of preference share capital, the cost is given here. So that means this company has to pay dividend at the rate of 10% on this preference share capital, and therefore 10% becomes the cost of preference share capital. Now when it comes to the debt, right, remember the debenture and the term loan, and that this is what we have to be very, very careful. Remember, when you borrow, you pay interest, but your effective outflow on account of interest is not same as the rate of interest. Meaning what? Meaning, if this hotel has issued debenture at the rate of 12%, That means on this debenture, of course, this hotel is paying 12% to the people, to the debenture holders. But effectively, what is going from the pocket of this hotel is not 12%. It is less than 12%. And how would that vary? That would vary depending on what is the rate of tax. And why is that relevant? That is because, remember, when we borrow, we pay interest. And when we pay interest, we save on tax. And why we save on tax? We save on tax because the amount of interest that we pay is tax deductible. That means from before we arrive at the figure of PBT, the interest that we are paying is deducted. That means interest gives us benefit in terms of tax saving. And that is why you can see, though the debenture is issued at 12%, the effective rate is 7.8%. And why the effective rate is 7.8%? And that is because 12% ka 40%, 40% is the tax rate. It is 4.8, right? So 12 minus 4.8. So that means I am paying interest of 12 rupees and I am saving of tax of 4.8 rupees. And therefore, therefore effectively, what is going from my pocket is 7.2%, right? 7.2%. So that is my effective cost of borrowing. And same is the case in case of term loan also. So what do? You find out the cost, and these are the sources, amount of the capital that I have brought in, and this is my weight. So this is my weights on what? Weights on the amount of capital that I have brought in. And what I need to do is I need to apply the cost with the weights. And what do I get? I get my weighted average cost of capital, which is 9.2% in this case. So when you are looking at the free cash flow for the firm, you will have to use the weighted average cost of capital for the purpose of discounting. And remember, you call it weighted average cost of capital, or you call it cost of capital employed. Both would mean the same thing. Now remember, it is very easy to find out the cost of debt, but it is very difficult it is not that easy to find out the cost of equity. Why is that so? And that is because the cost of debt is given to you, as we saw in the example that we have discussed, that the cost of debt debenture is 12%, the cost of term loan is 9%, cost of the preference share capital is 10%, and then of course you make the adjustment for the taxes in case of debenture and in case of the term loan. But in case of equity, it is very difficult to find out the cost of equity. And why it is difficult to find out the cost of equity? And that is because with regard to the share capital, the companies do not pay any fixed dividend. There is no fixed outflow on account of the equity share capital. So if the company makes profit, company does not make profit, company will not pay dividend on the equity shares. Company makes profit, but the company can still decide not to pay dividend on the equity shares. And therefore, how do we decide the cost of equity? Friends, remember, generally speaking, what is the cost of equity? Cost of equity is nothing but expectations of the shareholders. Return expectations of the shareholders is the cost of equity. But the problem is, a company like Reliance, or a company like Hindustan Unilever, or a company like Maruti, or a company like Bajaj Auto, or a company like Aditya Birla Group. Now, these companies do not have one or two shareholders. These companies have millions of shareholders. Now, if these companies have millions of shareholders, how do you figure out as to what is the return expectations of different shareholders so as to use that as a cost of equity? Not possible. And therefore, what you do, you use a model which is known as CAPM model, capital asset pricing model. And what you do in this case is, and this model, friends, is used world over, very extensively used model for the purpose of finding out the cost of equity of the listed entities. And in case if you want to find out the cost of equity of an entity which is not listed, you can take the cost of equity of a listed entity and make certain adjustment for the differences that would be there between a listed company and an unlisted company. So how does it start? It starts from the risk-free rate. So that means the government of India's 10-year bond, whatever is the government of India is paying as interest on those 10-year bonds. So that becomes the risk-free rate. And I'm sure you can understand why it is risk-free rate, because this is the instrument which is issued by the government of India. If that cannot be risk-free, then nothing can be risk-free in this country. So that you start with the risk-free rate. Then you take the figure which is known as beta. Now what is beta? Beta is an indicator of risk of the entity, in this case this hotel, vis-a-vis the market. So today if you want to find out the beta, you do not have to do any separate exercise. You can go to internet, you can go to the stock exchange, website of stock exchanges, you can go to the website of different banking, the finance related portals, and you would be able to get the beta of a particular company. You would also be able to get beta of a particular industry. So you pick up that beta and you write it here. So what beta will generally be around 1. It can be less than 1, it can be 1, or it can be more than 1 also. But beta will never be negative. I mean, this is what is my understanding. Beta will never be negative. Sometimes, some other time in future when we have another session, because that's a topic by itself. So if beta is less than 1, that means this company or this hotel that we are trying to value is less risk prone to the market developments. If the beta is more than 1, that means this hotel that we are trying to value is more risk prone than the market. Meaning what? Meaning if beta of this hotel, let's say for example, if the beta of this hotel is 1.5, it means what? It means if the index moves by 1%, the price of this hotel will increase by 1.5%. If the index in the return on the index increases by 10%, then the return on this company will be 15%, and vice versa. If the index goes down by 5%, then the stock price of this hotel will come down by 7.5%, because this is 1.5. And then you take the market return, and again this market return is not a challenge. Again, it is readily available. So you want to find out as to what is the average market return in case of the infrastructure industry, hotel industry, pharma industry, finance industry, banking industry, real estate industry, aviation industry, telecom industry. So all those market return for 5 years, 10 years, 15 years, 20 years are readily available on the website of different stock exchanges and also different portals. So you take the market return, and from that you deduct the risk-free return. And when you solve this equation, the number that you arrive at is known as the cost of equity. And really speaking, when we do these real life valuation, we will not take 15% here or 15% here. What we will take here is the figure that we would have worked out, that we would have arrived at using the capital asset pricing model. So this is what is the fourth step, and that is using the cost of capital. Now what we do, we come to the step number 5, and that is compute present value of free cash flows for the explicit forecast period as well as for the terminal period. How do we calculate the present value of the cash flow during the explicit forecast period? So we will use the cost of capital as the factor, and this, remember, this will keep on decreasing. So what we do, let's say for example, the cost of capital is coming if the cost of capital is coming 10%. So we'll, for the first year, the discounting factor is going to be 1 divided by 1.10. For the second year, it is going to be 1 divided by 1.10 raised to 2. For the third year, it is going to be raised to 3. For the fourth year, it is going to be raised to 4. So this is how we will find out the discounting factor using the cost of capital for all the 5 years. Multiply this discounting factor with the projected cash flow of these 5 years. And when we multiply and when we total the figure that we have arrived of all these 5 years. So total of that becomes the present value of future cash flows during the explicit forecast period. Now we also need to find out the present value of cash flow for the terminal period. Now remember, we discussed terminal period. How do you take the cash flow? So you take the cash flow of the 5th year, that is the last year of the explicit forecast period, multiply this cash flow with the growth rate of the terminal period. So that becomes the cash flow for the terminal period. Now in this example, we can say, so this is the cash flow, as you can see, of the 5th year here. And what you do, you multiply it with the 1 year, and that is the growth rate during the when the terminal period starts, and then you divide this figure by cost of equity, cost of capital, minus the growth rate. So this, when you calculate using this formula, you will get the cash flow for the terminal period. And by the way, invariably you will see that the amount of the free cash flow that you arrive at for the terminal period is many times more than the free cash flow that you will arrive for the explicit forecast period. And now what you do, this free cash flow you have got for the terminal period, you again have to discount it, and this is how you will discount it actually. So you will take the discount factor raised to n meaning the last year of the explicit forecast period. In our example, it is going to be the 5th year. So this is how you will find out the present value of future cash flows for the entire project. Meaning what? Meaning what you have to do is take the present value of free cash flows of the explicit forecast period and add the present value of free cash flows for the terminal period. So when you add them together, you have got the value of this hotel that you are trying to value. So using the cash flows, using the cost of capital, you have arrived at the present value of the cash flow this hotel will generate during the explicit forecast period, which is 5 years, and also this hotel will generate during the terminal period. When you add them together, now that becomes the value of this hotel as a property. Now that becomes the value of this hotel as a property using the discounted cash flow method. Now we want to find out as to what will be the value of the company. So when I say value of the company, what does it mean? It means the value of share of this company. So if we have to find out value of share of this company, which is owning this hotel, we will need to make certain adjustments. And what adjustments do we make? So we make adjustment for surplus cash. Remember, so we have done the evaluation of the hotel using the discounted cash flow. Now this company owns only this hotel, and this company is having 100 crore of cash lying with them. So when you want to do the valuation of the company as such, what you will need to do, you will need to add the value of the hotel plus this 100 crore which is lying with the company, add them together and then divided it by the number of shares. That will give you equity value per equity share. And remember, it is not only the cash that can be there, it is also possible that this company, other than the hotel, this hotel that we are valuing, this company also has a parcel of land lying somewhere, right? So when we want to do the evaluation of the company, remember, not only we will need to take the value of the hotel that we have done in our discussion, we will also need to add the amount or add the value of this parcel of land which is lying somewhere of this company, add them together to find out as to what is the value of this company. And this is how you will make the adjustment. And when you are using the free cash flow for the firm, what you arrive at is known as enterprise value, and when you are using FCFE, free cash flow for equity, what you arrive at is known as equity value. And finally, as I said, dividing the enterprise value or the equity value by number of shares will give you enterprise value per share and equity value per share. So friends, this is all that I had to share with you with regard to how to use discounted cash flow method for the purpose of doing valuation of a real estate entity or a hotel for that matter. In case if you have any question, any doubts, any queries, I will be very happy to take them now. Thank you.